Sound Cartel.
If you own assets, are you sure that they're fully protected against all risk? And how confident are you that you're minimising the impact of taxation on your returns? From Sound Cartel, I'm Nicole Goodman, and this is Business Essentials Daily. Nathanael Lee is a partner at Mazars, one of Australia's leading international audit, tax and advisory firms. He says guarding assets is an art as much as it is a science. So, what exactly is asset protection? Nathanael's explaining to Jeff Waters.
Asset protection involves choosing how you own your assets. What structure will you own them so that you can protect them as much as possible? The goal is really to protect your assets from liabilities that might arise from outside risks, and also the tax that applies to the income that's generated from your assets, from your investments, and the ultimate capital gains tax when you sell them also needs to be taken into consideration. So structuring involves choosing the appropriate entities to own each asset so that you get the optimal protection for them.
How do you go about advising a client on the optimal structure to protect their assets?
Well, I often say that asset protection is really as much art as it is science, and I'll explain as we go along. A one-size-fits-all approach really just doesn't work. I like to follow a multi-step process. Firstly, I need to understand what assets a client needs to protect. Different types of assets could require different types of ownership structures. For example, are they looking to protect their family home? Are they looking to protect a rental property, or perhaps it's a business that they own? Secondly, what risks does the client face? Or what risks might they face in the future? Are they an employee? Are they already in business? Are they already a director? Will they become a director down the track? Are they looking to run two different businesses with different risk profiles? Thirdly, how are they going to fund the assets that they're wanting to protect? Are they using personal money that they've already paid tax on, or are they using cash that a company is generating, that the company's paid tax on? If they're financing the asset, well then what are the repayment terms? How are they going to pay off that debt? And fourthly, how long are they expecting to own the asset? Is it going to go up in value a lot? If so, by how much? Now, these questions, obviously, they may not have all the answers to, but it's important to get as much information as possible. And I often find that new clients have just been advised in the past that they should just acquire all their assets in a discretionary trust or a unit trust, for example, which is really just a one-size-fits-all approach. But that can create significant problems down the track with not being able to retain earnings, issues with application of Division 7A, etc.
You said that asset protection is as much an art as it is a science. Can you elaborate on that?
Asset protection is really about putting up as many barriers as possible, well before any risks arise. And there's a lot of laws that apply to this, insolvency laws, for example. There's always a risk that a liquidator or a bankruptcy trustee is going to seek to claw back assets to try and undo the asset protection that you have put into place. Also too, there has been court cases, even in recent times, which has eroded the certainty of certain strategies. So what was viewed as very high protection has been found to actually not provide protection. So because of this, I advise my clients that really no asset protection strategies are guaranteed. It's about putting up as many roadblocks as possible between the risks that they could face and the assets that you're trying to protect. And the more roadblocks there are, the safer you'll be.
Can you give us an example illustrating the importance of good asset protection and structuring?
Yes, this is an example which I encountered many years ago when I was at a previous firm. It's quite a sad story and it's really stuck with me over the years. I had a client that operated a business through a discretionary trust. And when that trust had originally been established, both spouses, husband and wife, had been appointed as trustees. Now, there's really two critical issues with that structure. Firstly, the trust was operating an active business. So I think a company should have been utilised as the trustee. This would have provided some protection to the individuals because the trustee of a trust is liable for the debts of the trust, at least in the first instance. And secondly, only one trustee is required to have a trust. So even if they were going to have individual trustees, only one of them needed to be a trustee. Having both of them on there as trustees unfortunately meant that they were both personally liable for the debts of the trust. Now, this business operated for some years, and unfortunately it wasn't successful. They built up significant ATO debt for things like GST, PAYG withholding and employee superannuation, and as trustees they were both personally liable for those debts. They were also liable to the landlord for rent on the premises that they were leasing to run their business. Eventually the business stopped trading. It just couldn't make a profit. It generated losses. And both spouses, because they were both trustees of that trust, sadly, they had to both go into bankruptcy. And they had a family home, which they owned, and that was in joint names, so they lost their family home. Just a totally devastating result for them, which took them obviously years to recover from. So had that structure been better chosen, probably with a company as trustee, one spouse as the sole director, maybe even look at the ownership of the family home, having it in the spouse's name who is not a director, it may have been possible to save the family home, and also the spouse who wasn't a director wouldn't have had to go into bankruptcy. So this example, it's quite a sad example, but it's really stuck with me over the decades since and really made me appreciate the value of asset protection and getting the structure right.
Nathanael, what if I'm listening to this and I'm concerned that my assets aren't properly protected? What are the first steps I should take?
I'd definitely recommend that you speak to your accountant. Your accountant will be able to advise you on what level of protection you've currently got. You can discuss with them the risks that you're concerned about, and they know your business, they know your assets, they'll be able to give you advice on any changes that you really need to make.
That was Nathanael Lee, partner at Mazars. Business Essentials Daily is a Sound Cartel podcast. Producers are Nick Schildberger, Chris Ashmore, Jeff Waters and myself. Technical production by Pete Letts. I'm Nicole Goodman. Thanks for listening. We'll bring you more Be Daily next week.